At the end of a period, companies prepare financial statements that present the data on all jobs manufactured and sold. The cost of goods manufactured schedule in job order costing is the same as the one introduced in the previous chapter, except the schedule shows manufacturing overhead applied rather than the actual overhead cost. The company adds this amount to direct materials and direct labor and to determine total manufacturing cost. Companies prepare the cost of goods manufactured schedule directly from the work in process inventory account. Note that the cost of goods manufactured, $39,000, agrees with the amount transferred from work in process inventory to finished goods inventory. The predetermined overhead rate is established before the period begins and is based entirely on estimated data. The total manufacturing overhead applied to work in process will generally differ from the actual manufacturing overhead cost. The actual manufacturing overhead costs are not known until the end of the period. The overhead that is applied to jobs and work in process inventory is based on estimates that were established at the beginning of the period. This estimate will rarely equal the actual overhead cost. The difference between the overhead cost applied to work in process, as well as the jobs, and the actual overhead cost of a period is called either under or overapplied overhead. During the accounting period, we debit manufacturing overhead for actual cost and credit this account for the amount applied to work in process inventory, as well as each individual job. At the end of the year, the manufacturing overhead account will likely have a remaining balance. When manufacturing overhead has a debit balance, overhead is said to be underapplied. Underapplied overhead means that the overhead assigned to work in process is less than the overhead incurred or actual overhead. When manufacturing overhead has a credit balance, overhead is overapplied. Overapplied overhead means that the overhead assigned to work in process inventory is greater than the overhead incurred. At the end of the year, a company must eliminate any balance in manufacturing overhead by an adjusting entry that offsets cost of goods sold. If overhead is underapplied, we need to debit cost of goods sold, whereas if overhead is overapplied, we credit cost of goods sold. To illustrate, Wallace has a $1,400 debit balance in manufacturing overhead. This occurred because the amount of overhead applied, $22,400, was less than the amount incurred during the period, which was $23,800. The adjusting entry for the underapplied overhead is a debit to cost of goods sold for $1,400 and a credit to manufacturing overhead for the same amount. After Wallace posts this entry, manufacturing overhead has a zero balance. When preparing an income statement, Wallace will report the cost of goods sold after adjusting it for either under or overapplied overhead. I was looking for something to help illustrate under or overapplied overhead, and this is the best that I could come up with. What I'd like you to think about is if you've overapplied, then you've applied too much, and you need to reduce your cost of goods sold. So I want you to think of you have to credit that account. Whereas if you underapplied, again, in this case, you didn't apply enough, so then you need to increase your cost of goods sold. And I want you to think of debits. Remember, debits are going to increase our expenses. The solution to this exercise will be provided in the next slide.